Good evening. How are you all doing, students? Today, when we are speaking, it is the council meeting which is in progress. I'm waiting for the updates. It is expected that there would be a press conference around 6:15. This is what the update says. So as of now, we won't get to know what are the updates. But yes, few important things were lined up for this council meeting. First one was certain important rate changes. Second one was the recent Safari retreat decision. It is heard that Council is thinking of amending the law to make certain changes that have come up because of this decision. And then another important issue that was supposed to be discussed today was that whether there has to be some relaxation given on GST applicable on insurance premium. So these were some important lined up items. Let's hope we get to hear some more news relating to this before the end of our session. So let us start. The topic that we are going to start today is one of the most crucial topics from the perspective of GST law, GST practice, and also your exams. Because this particular topic has lot of issues. This particular topic has lot of what you can say different types of uh, disputes, different types of difference of opinion. That is why this particular topic has gained lot of importance in our curriculum as well. Now, let us understand, students, what this topic is dealing with. Our entire syllabus is mainly focused on the outward side. When our entire syllabus is focused on the outward side, so we study the topics like supply, place of supply, time of supply, value of supply, composite supply. All those topics are mainly covering the credit side of your P&L. However, this topic is focusing on the debit side, that is your expenses side. Now, GST is designed on the principle of VAT, VAT, which is value addition tax. Now, what is this principle of value addition tax? The principle is if I have purchased something for 100 and I'm selling for 150, I should pay to the government the tax only of 50 rupees, which is my value addition to that particular product, which may be goods or service. Now, in this particular case, when we are talking about value addition tax, which is this 50 rupees, it is the value addition. Now, how to compute this value addition tax? For that, there are different methods. Different countries have adopted different systems, out of which India has adopted the system called as the invoice system. Yeah, sorry. So I was saying that this topic deals with the debit side of your business. Now, when I'm saying debit side, what it basically includes, what it basically covers. So the debit side is the input side of your business. Now, see, I'm not only talking about your P&L debit side. That is why I'm using the word input side of your business. What is the input side of your business? input side of the business is whatever you are getting into the business for giving your output. Now, broadly, what we are getting into the business has been classified into three categories. One is inputs, one is input service, one is capital goods. So broadly, your business functions using these three items on the input side, where inputs are those which are other than capital goods. Then you have input service, means all services on the debit side of your business. And thirdly, all those items which we capitalize in our books, which we call as capital goods or assets. So your business functions on these three input items. Now, as we were discussing, India follows the invoice system of computing VAT, whereby we do not directly compute GST or VAT on that 50 rupees. Rather, what we do, we compute GST on our output, which is 150. We compute or find out the GST paid on our input, which is 100. And we knock off both the taxes to get ultimately the tax on our 50 rupees, which is the value addition tax. So in India, we compute the value addition tax, which is now named as GST, by following the invoice method. And in invoice method, we take output tax, that is a tax on your output side. We take input tax, which is the tax on any of these three items, input, input service, capital goods. We knock off both the taxes, which is called as setting off. And the difference we pay, which is our final liability payable to the government, which is also called as the output tax or the ultimate liability payable. Now, in this whole concept, understand the importance of this tax paid on input side. VAT will be achieved only when you are able to knock off, you are able to set off the tax which you have paid on the input side. And that is what is possible by always focusing on the input side taxes, and that is what is called as the input tax credit. Now somebody will ask me, sir, why they have used the word input tax credit? So first, remember whatever I've explained just now. So we are now talking about the taxes which you have paid on your input side, that is while procuring goods or services into your business. So since it is the input side, that is why it is called as input tax. That is okay. Why it is called as credit? Now there are two logics for that. First logic is, since this amount will go to reduce your output liability, that is a tax which is on your output side, which is your actual liability. Since this amount will go to reduce your liability, so anything which is reducing your liability is a benefit because it reduces your liability. So anything which reduces liability or increases assets is benefit for the business. And in accounting parlance, any benefit is credited. This is the one logic, but I believe this is not the perfect logic. The perfect logic is the second one, but this is the logical logic. So what is the logical logic? Why it is called as a input tax credit? Firstly, because it is a tax on your input side. And why it is credit? Because it is a benefit for the business, because to this extent, your output liability, which is your actual liability, is reduced. Fine. Now comes the point of credit reason number 2, which according to me is the technically correct reason. For this, we have to understand slightly the accounting entry. When I make a purchase, let us say my purchase is of rupees 500, on which the GST paid is rupees 50. So my journal entry would be purchase is debit, input GST, whatever it is, C, S or I, that is debit, 50 rupees, to my creditor, which is 550. So purchase is 500, input GST by whatever name it is, C, S, I, 50, and credit is my creditor, which is 550. So in my books, this input tax is appearing as a debit balance. It is the asset. It is always my debit balance carried in the balance sheet asset side. However, the entire law, we are looking from the government side, or let us say not even government, the portal side. Like how you are maintaining your records of output tax, input tax, etc. The portal is also maintaining your records. In the portal, they have maintained or they have created this ledger which is called as electronic credit ledger, which is showing your input tax credit amount. And most important point, that is the government's books. Now we all have studied right from standard 11 the passbook and the bank book concept for in the chapter of BRS, that what is debited in your bank in your books is credited in the bank's records, because what is debit for you is credit for them. So similarly, if I'm debiting this input tax on my purchases, the same input tax is appearing as a credit entry, as a credit balance in the books of the government in the portal. So in their books, my input tax is appearing as a credit entry, as a credit balance. And that is what is the technical reason of naming it as input tax credit. They could have very well called it as input tax debit. Anyways, they had to use a term they were having the power to define. They chose correctly input tax credit. So I hope firstly, this is clear to everyone why it is called as input tax credit only. Any questions up to this basic, whatever we have discussed? Students, anybody has any questions on whatever we have discussed? Okay. Yes, good evening, everyone. Okay. I think Hemant has shared something. Okay, it is your LIC premium. So what do you want to say, Hemant? It is LIC collection branch, servicing branch, payment gateway, policy number, plan term, insurance sum assured, number of installment, total premium. Okay, so beta, they have not given you the breakup, na? They have not given you the breakup of no. It is not beta without GST. See, they have not given you the breakup. See, read how they have given this. They have said total premium, and in total premium they have written 4794 without giving the breakup.
Oh, sir, they have said CGST, all that they have said 00.
See, I believe it is not zero. It is simply because they have not given the breakup. This is what I believe, because the main question is why they have not given the breakup. Reason is because when this policy is given to you, you are an individual. We have taken this policy in our individual name, correct? We
Yes.
are anyways not eligible for any input tax credit on personal expenses, correct?
Okay.
Even
Okay,
in
sir.
17.5, what we are going to study today in the block credits, you have these premium which is blocked. That is why, and plus, when we will study the topic of maintenance of accounts and records, where the invoice topic will come, in the invoice topic, there are different entities who are given the option of not preparing the invoice in the detailed format, what is applicable to normal businesses. The entities are banks, the entity is cinema, the entity is our insurance companies, the entity is your goods transporter or the sorry passenger transporter. So let us say, even if you go to a movie, you are now, let us say you go and watch Pushpa 2 and the ticket price is 500. Do you get the breakup in that ticket of CGST, SGST? Has anybody seen the ticket, or you can just Google and check it on any of these apps, Book My Show app. They are not giving you the breakup. Similarly, you are traveling by AC bus, which is leviable to GST, they are not giving you the breakup. Why? Because they have been given that exemption, not exemption from GST, it is the relaxation. Exemption is the wrong word because exemption deals with tax. They are given relaxation from preparing of detailed tax invoice. And that is why you will find the receipt something like this. Am I clear, beta?
Okay, sir. Yes.
Yeah,
Yes.
but they are liable to pay. In fact, in our previous lecture only, when we were dealing with value, if you remember, we discussed that whenever it is a life insurance, you have three types of plans, which will be either endowment plan, which will be either annuity one single premium policy plan, or it will be your this plan, what we say, term plan. And in
Yes.
all these three cases, there is GST. In term plan, on entire premium, there is GST. And in the other two, we follow the valuation rule where they have given some percentage as the value. Correct?
Sir, on the bottom of you see the receipts. Please go to the bottom. It
Yes,
says
I'm on the bottom.
GST bond by LIC of India. What does it mean, sir? I thought that it is. Uh,
So see, I'm just trying to locate where it is written. I'm seeing your receipt only.
the
Uh,
bottom, sir. GST bond by LIC of India in blue. It says in blue color, the letters.
Blue color, the last line. See that is what I'm saying. See, they have given the GST amount
Uh,
107.86.
but it says bond by. What does it mean?
Why it is borne by? Because it is like this. I've included in the price. It means I'm giving you the MRP. Now, when I'm giving you the MRP, it is included in the
Mm.
price, na?
Okay. I thought that they are paying for the
See,
ins-
understand one thing. Even if they are paying, they are including it. See, they are doing costing. In costing, they have included this cost, na? So whatever is
uh,
their cost is ultimately part of your price. It is as simple as that. Costing, na?
okay, sir. Okay.
So they are very smart. Now see, these are all business tactics. What happens when you are comparing different companies' plans? You need to know
Mm.
ki what is the total outflow that is going out of your pocket. Now it is clear that you are not going to get any ITC of this, correct? Because it is personal.
Correct.
That is why they include it, and just to show off, I'll use the word show off, that how much they care for you. They are showing it like this, that it is borne by LIC. Even if it is borne by LIC, we know costing. Costing says that whatever is your cost, you add it to the price of the product. So in costing, they have included this in the price.
Okay, sir. Understood now.
Okay. Now, acha, do you remember, beta, what was the valuation rule? Anybody remembers what was the valuation rule? Let us cross check if the amount of GST is coming correct.
The valuation rule says that, okay, you are saying that 1.18 we have to divide.
No, no,
Uh,
no. If you remember, this is life insurance, correct?
yes, yes.
Is it term
But-
plan?
No, it is not a
No.
term plan. It
It
is
is
endowment
endowment.
plan. Yes.
Now, is it first year or is it subsequent year? It says renewal. It
Subsequent,
means it is subsequent year.
subsequent year.
Subsequent year, if you all remember, the this was
12.5%.
no 10%. Na?
It says 12.5%, sir.
Just check. I don't recall. I don't
Oh,
remember.
okay.
Just check. 1 second. I'll open. We studied in the last lecture only, na?
Yes, sir.
What was the value in case of renewal? Can you all see my screen?
Yeah, we can see. This
I've
is
opened the valuation chapter. I'm trying to
32.
locate that rule.
32. 12.5%, sir. That is
For renewal,
4C. Yes.
correct?
Yes.
Now see, take a calculator. Now how much is
Yes.
your this total amount? 4794.
Yes.
From that, reduce this 107.86, which is the GST, correct?
Oh, okay. Yes.
So what is the amount that you are getting on your calculator?
479 minus 107.1.
So 108, you can reduce 108,
4796 minus 108. It comes to 4688.
correct? 4688.
Yes.
Now take multiplied by 12.5%,
Multiply by 12.5%. It comes to 586.
correct? Multiplied by 18%,
Multiply by 18%. 105.
correct? So it is
Okay.
coming to around this particular amount.
Oh, but what is that you said, sir? First is you said 12.5% I calculated.
Because 12.5% is the valuation, na? You just read in the valuation
Okay.
rule, na?
Okay. Valuation. Okay.
See, because the total premium that they are charging, a major
Yes.
part of it is going to investment, na? We discussed this in the last lecture. I gave you the logic.
Okay.
We only want of the insurance portion. So the law says that we are presuming insurance portion is 12.5%.
Okay.
So we calculated 12.5%.
Okay.
Correct.
Okay. Out
And
of
then,
that, you have to take 18%.
Oh, because 18% is the GST rate, na?
Okay, sir. Okay, sir.
And it is expected that it will be reduced today. Because today, as I mentioned at the start, in the council meeting, one of the biggest proposals is reducing the GST on the insurance. And that is one of the biggest agenda. Many ministers have agreed to that prior to the GST council. See, because ultimately it is a part of politics. So many of them have conquered that there should be a reduction. So let's hope we'll get to know soon that what are
Yes,
the
sir.
council decisions. Correct?
Okay, sir.
Okay. So with this background, let us start. Now, ITC or input tax credit is your debit item. Debit item means it is whatever is coming into your business. I call it as the input side or the debit side of the business. Whatever is coming into your business and the tax is paid on that, that is your input tax. Now, when you satisfy the conditions of this chapter, what we are going to study, this input tax is allowed to you as a credit. Credit means that now you can set it off against your output liability. So only when you satisfy the conditions of this topic, of this chapter, then the tax which you have paid on the input side, which is I'm calling as input tax, becomes input tax credit. And once it becomes input tax credit, you can now set it off from your output liability. So in this topic, we will understand when input tax becomes input tax credit. Second, what is included in input tax? Thirdly, once it becomes credit, how can we utilize it from our output tax? Whether there are restrictions, whether I can utilize full, all these things are covered in this particular topic. Now, again, coming to definitions, agent we have already seen, business we have seen, capital goods. First important definition. Again, as I mentioned few minutes back, the debit side or the input side of your business is divided into three categories. Inputs, capital goods, both these are goods, and you have the input services. Whatever taxes you have paid on these three items becomes your input tax, and if you satisfy the condition, it becomes your input tax credit. So whatever GST you have paid on these three items, that becomes your input tax. Now, what are these three items? Let us understand. So what is the definition of capital goods? Capital goods is defined to mean goods. So firstly, in order to become capital goods, it cannot be service. Now, why I'm emphasizing on this? Somebody will say, sir, it is so plain. Why are you emphasizing on this? The reason is we even capitalize services. So you may be capitalizing services in your books. I'll give you example. You have purchased an immobile property or you have got an immobile property constructed, and when you are getting it constructed or when you are purchasing it while it is under construction, it is leviable to GST and it is falling in the category of works contract service. So what you are purchasing is a service, the works contract service, which is capitalized in your books, but it does not becomes capital goods. Second example of this is you are buying or you are getting some software like ERP made for your company. Now, when you are getting ERP made for your company, again, ERP, which is a software, is a service. And many times these softwares, SAP, ERP, cost company in hundreds of crores. So when I'm, let us say, spending 2.5 crores on getting this ERP made for my company, the SAP made for my company, I capitalize this software cost in my books. However, still it will not be called as capital goods. It remains input service. So this is what I wanted to emphasize, that everything that we capitalize in our books cannot become capital goods because the definition starts with the word means, goods. So only those things which are goods in the first place can become capital goods. Now, when they will be capital goods, the answer is simple: when they are capitalized. So if you are capitalizing them in your books of accounts, they become capital goods. If you are not capitalizing, you're writing off in P&L, then they are called as inputs. So it is capitalized in the books of accounts of the person claiming the ITC and which are used or intended to be used in the course or furtherance of business. So that is why whatever are your non-business costs, non-business expense, your personal expense, that will never be eligible for ITC because they will never fit in the definition of either capital goods or input service. For example, I buy a refrigerator. which may be a capital goods for me. But if it is not for the purpose of my business, it will not be considered as capital goods and it will not be eligible for ITC. See, many
So
times what
what,
happens?
sir, what
Sorry,
is the reason for excluding that software item? As
it
what
is
is the
not
reason?
excluded, beta. It is falling here. Here, it
Oh,
is covered.
oh, okay, 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 okay.
What I only mean to say that there is no concept of capitalized service. So it is eligible. You get credit of everything that is in business. The problem is it will not be falling in the definition of capital goods. Not problem. That is the situation. It is not capital goods. It is input service. Correct?
Understood, sir. Understood.
Okay. Now, see the point is when we are talking about this concept of capital goods, input service, I was explaining this that this particular point is very relevant. So when I buy something which is a personal item for me, which is a personal expenditure for me, many times you'll see that nowadays people have got into the habit of giving their GST number everywhere. So even if I go to buy a microwave oven for my kitchen or even a refrigerator or even a television for my house, I give my GST number. And why I'm doing that? Because I believe that if I do that, he will upload that in his GSTR1. It will reflect in my 2A and it does because I've given him GST number. So he's going to upload it with my GST number. It reflects in my 2A, 2B. And I believe that I will get ITC. The answer is no. I will not get ITC for the simple reason that ITC is allowed only when it fits in any of these three. And in all these three definitions, the common condition is it should be used or intended to be used in your business. So if it is my personal property, personal expense, it will never be eligible because of the definition itself. Conveyance, exempt supply, I'm not referring now because it is right now not required. We'll see to that if required, whenever required. The second definition, which is opposite of capital goods, is input. And input has again been defined to mean goods. Which goods other than which you have capitalized? So simply all the goods that are coming into your business are bifurcated into two categories only for the purpose of ITC. One is either they would be capital goods, and if not, they all would go in inputs. Then comes the third category, which is input service. Input service means all those expenses for which you are getting the SAC code bill, that is service accounting code bill. So for whatever you are getting the HSN code bill, those are goods. For whatever item you are getting the SAC code bill, like professional fees bill, audit fees bill, legal fees bill, rent bill, all these are having SAC code. They are all services and they are classified or termed as input services. Correct? Now, the common part in all these three definitions is that these would fall or would be eligible for ITC only when you are using them or your intention is to use them for business. If your intention is to not use it for business, it will not fall over here. Fine. Now, what is the definition of input tax? As I said, the taxes that you are paying on the input side. But which taxes? Answer is only GST taxes. So what they have said, in relation to a registered person means the central tax, state tax, integrated tax, UT tax, which is charge on supply of goods, service or both made to him and includes all these taxes which he himself is paying under the RCM mechanism. So all taxes which either the supplier is charging on me when I'm making purchase from the supplier, or if he is not charging but I am paying under RCM, all the taxes but which are GST taxes, central tax, state tax, UT tax, integrated tax, they are my input tax. Now there is one tax which is a GST but is not eligible because it is not input tax is the tax which a composition dealer is paying. So if I'm buying something from a composition dealer, the composition dealer is paying that 1%, 5%, 6% tax. However, that tax is not, I repeat, that tax is not input tax and I don't am I don't get credit of that tax. Now, what is the definition of input tax credit? It means simply credit of input tax. Now, what is credit? Credit means once you satisfy the conditions that we are going to study, these taxes are allowed to be claimed by you, which you can set off from your output. So the moment you satisfy these conditions, these input tax becomes input tax credit because you can claim them and you can use it for adjusting against your output tax. Fine. So with this, few important definitions to start with, we go to the provisions of ITC. Now, broadly, ITC covers only three sections, broadly, 16, 17, 18. 16, I call it as mother. 17, I call it as father. 18, I call it as your brother, sister, that is your sibling. Why? 16, I call it as mother section because, like mother, kind hearted, 16 gives me the credit. It says that I will give you this credit only you fulfill certain conditions, same like what mother does. 17 is father. Why? Because 17 is very strict like father. It says no. Even though mother is allowing you credit, even though you have satisfied all conditions of mummy, still you will not get credit, or I will allow you only proportionate credit, part credit, not complete credit. So 17 is strict like your father and it is not allowing you complete credit, or it is allowing only proportionate credit. And third, 18 is like your sibling, your brother or sister, which is allowing you credit in some different circumstances or even taking away your credit in some different circumstances. So same like your naughty brother who is even taking away your chocolate, or like your kind-hearted sister who is giving even her share of chocolate to you. Similarly, 18 either gives you credit in some special circumstances or takes away your credit which you were already allowed under section 16. So 16 gives you credit, 17 blocks the entire credit or proportionate credit, and 18 allows or disallows credit in some exceptional circumstances. With this background, let us start with these sections. Now, as I said, these are the three main sections of ITC, but yes, we have some connected sections to this, and most important, we have certain rules. These rules are connected to each of these sections. So now when we study these sections, we study it along with the rules. Now what is section 16 dealing with? The heading says it is eligibility for taking the input tax credit. So when will you get this credit or benefit? When you satisfy the eligibility and conditions. Now what is the eligibility? The eligibility is in the first three words. I allow credit only to a registered person. So until and unless you are a registered person, you are not eligible for credit. So first part of the section says that credit will be allowed to every registered person. So what it says, every registered person shall, subject to conditions, restrictions as may be prescribed. Again, whenever the law says prescribed, it means prescribed by rules. So subject to certain conditions which may be prescribed and in the manner specified in section 49. So main sections are 16, 17, 18, but we have connecting sections. What they are, we will see. So the manner of taking the credit is given in 49. Now what it says, every person shall be entitled to take the credit. Now what is taking credit? Taking credit means whatever taxes you have already paid on your input side, that tax you can put in your electronic credit ledger, and putting it in your electronic credit ledger is taking the credit. Taking the credit means it becomes a credit entry. Now, most important point is that you can take this credit. This is the first step, which is taking credit. Second step is whatever credit you have taken, now you have to utilize the credit. How to utilize, that is the next part that we'll study later on. But the first step is you can take the credit. Now, what it says, credit of what? You can take credit of the input tax. What are input taxes? Input taxes are all the GST taxes which you have paid on any of these three things. Charge on any supply of goods, service, or both, which is made to him, which are used or intended to be used in the course of business, and the said amount shall be credited to the electronic credit ledger of that person. So, the moment you satisfy the conditions and restrictions, I allow you to take this credit. And when I allow you to take this credit, it means that this particular amount of credit would be credited to your electronic credit ledger. In other words, taking credit is the process of passing that entry, showing that amount in your electronic credit ledger. Is this clear? Any questions? Students, speak to me. This is a very common chapter. This is a very practical and a very important topic. So keep discussing with me, keep speaking to me so that if there are any doubts, questions, we can discuss and get it cleared. So subsection 1 says that there would be certain conditions, restrictions, subject to which you can take credit, and taking credit means that this credit would be shown on the credit side of your electronic credit ledger. Correct? Now, eligibility is registered person. Now, what are the conditions? The conditions are these clauses: A, AA, B, then B, A, C, D, etc. Now, what subsection 2 says? Notwithstanding anything contained in this section. Means what? This section may say anything. No registered person shall be entitled to the credit of any input tax in respect of following supplies of goods, service, or both, unless. So, until unless you satisfy these conditions, you are not eligible to take the credit. You are not eligible to the credit. Now, we will go to each and every condition along with the relevant rules. So, you can see there are various rules also applicable from here, right? Now, before I go to the rules, let me just take one more section which is connected with taking the credit. It is section 41. What is the heading? Now, interestingly, see, different sections have used different headings or different terminologies. Section 16 was using the word take credit. 41 heading is using the word avail credit. So what it says, every registered person shall, subject to conditions, restrictions as may be prescribed, be entitled to avail the credit of eligible input tax as self-assessed tax in his returns, and such amount shall be credited to his electronic credit ledger. So what it says, again subject to conditions, restrictions, what we are going to study. 41 says you are entitled to avail the credit of the eligible input tax as self-assessed. Now, few things that are important over here is that once you apply all the conditions mentioned above, your credit becomes an eligible credit. So that is the first part. They are saying now once you have satisfied the above conditions of section 16, your credit is now becoming a eligible credit, right? Second word that is very interesting is they have saying as self-assessed. Now, what is self-assessed? We use this word in income tax also, customs also, self-assessment. What is self-assessment? One is assessment by the officer, by the department. So when they do your computation, they do checking and confirm that, okay, your computation is right, your tax liability is right. That is the assessment by the department. But before that, you have the opportunity of doing it by yourself. So the law first gives you the opportunity that before the officer does it, you do it yourself. So what you do yourself is what is called as the self-assessed tax. Now here they are saying that this input tax credit, we are allowing you to take it by yourself. Means they have kept the scope open that later on the officer will also come and check. But for the time being, you need not wait for officer's confirmation. Once you feel you have satisfied the conditions, you can avail the credit of this input tax. And where you have to avail? You have to avail in your 3B return. And once you avail it in your 3B return, the amount will be credited to your credit ledger. So 16 said that you should be a registered person. 16.1 saying registered person and these goods or services are for the purpose of business, then you take the credit. And 41 adds one more condition, that not condition, I'll say it is just a continuation of 16, At the moment you satisfy 16 conditions, these credits will become eligible. But remember, you are taking this on your own assessment. Means
Sir,
it need not be the final confirmed credit. It is the credit as per your self-assessment. Yes, beta.
it is avail means to make use of. Am I right, sir?
No, 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 no. Availment is taking. To use, you will get another word which is utilization. That is what we will see in section 49.
Okay.
So till now, see, we are on the first step, that is first getting the credit. Now that is what I'm saying. Different sections have used different word. 16 has used the word take the credit. 41 is using the word avail the credit. All this is the first step, that is getting the credit.
Okay, understood,
That
sir.
is avail. Correct?
सर जब हाँ
Okay,
लाइक हम
sir.
जब रिटर्न फाइल करते हैं तो उसमें हम लोग शो करते हैं कि इनपुट टैक्स क्रेडिट हमारा इतना है, अदरवाइज जब तक नेक्स्ट पार्टी कंफर्म नहीं करती वो डिफरेंस आ जाता है कई बार,
Hmm,
इट्स लाइक
hmm,
दैट.
hmm, hmm. So what is your question? That is the procedure right now. Correct?
सर
So what is
दैट
your question?
दैट इज अवेलमेंट
Huh,
हियर.
so availing means simply availing means showing it in your 3B return, and availing means it adds to the credit balance. So let us say my opening balance at the start of this month was 100. During this month, I received multiple invoices. I checked all the conditions and found out of these invoices which are eligible. And those eligible items, when I accept in my return or I add in my return in the credit column, that will add to the 100 balance which was there at the starting. So my balance of this month, let us say 400 eligible tax invoices have come. So 100 was the balance. Now my total amount of credit will become 500. So I will say I have availed 400. So in this month or at the end of this month, my total available balance is 500. Now I will see what is my output liability, which I'll get from the GSTR1, because in GSTR1 I have shown my sales. From there I get my output liability. My output liability is coming to, let us say, rupees 740. So output liability is 740. I have the total credit balance available rupees 500, which was 100 opening, 400 availed in the current month. I will set off this, and the balance 240 I will pay from my pocket, which is from the cash ledger.
What is the difference between that section 16 and section 41?
See, 16 is more dealing with the conditions. Key, you will get credit only when you satisfy this condition. 41 deals with a process which says that once you satisfy 16, the credit becomes eligible. So it means you first see not only 16, 16, 17, 18, everything, because that collectively will tell you ki what is the eligible amount. And now
In
this
both,
eligible amount, you show it in your return, because before, until unless you show it in your return, it will not add to the credit balance. So if you all have filed the GST returns, you will know this, that the moment I show it in my 3B, which is my return, in the correct table, in the correct column, my balance of the ITC ledger increases. So 41 is talking about the process, and it is also giving one sort of warning or caution that remember that this is not final. This is for the time being assessed by yourself, which may get changed or which may get reversed later on if it is found incorrect.
in both places, it is saying credited to the electronic ledger.
Yes, yes,
So,
yes.
but
So,
then
so what is your doubt?
that means, is it a double credit or?
See, it cannot be double credit because credit will be allowed only once. The point
Okay.
is, see, it is like this. I am giving you conditions in 4 different places, right? Like 16
Uh,
also, 41 also. So
okay,
everybody will
okay,
repeat the same thing. Now what I will say, Hemant, you do this, I'll give you the credit. Then in the next
okay,
section, I'll say, okay, Hemant, you do also this, then I will give you the credit. Then in
okay,
another
sir.
section, I'll say, Hemant, remember to do this also, then I will give the credit. So in all
Says,
sections, I'm saying I'll give you credit, but I'm adding some conditions or some
okay.
criteria.
So basically, cumulative conditions, you were saying.
Yeah, they are.
Yeah,
That is
yeah.
why, see, that is the best part of our module. They have given you
Okay.
all relevant things at one place so that you have a holistical view. Correct?
Oh, okay, sir. Okay.
Now, what does subsection 2 says? This credit of input tax, which you have availed under subsection 1. So now you have availed under subsection 1 in respect of supplies of goods, service, or both. The tax payable whereon has not been paid by the supplier. Now, that is where the relevance of this word self-assessed comes. Self-assessed means you did by yourself, you took the credit, but later on it was found that the supplier has not paid this tax for which you have taken credit. Now this you come to know only in the next month, because this month you are filing the return, supplier is also filing the return, because both our due dates are 20th. Now before 20th, like today is 21st. Now yesterday was the due date of filing return. So I also filed, my supplier also filed. Now I do not know whether my supplier filed or not. That I will come to know only today when I go and check the returns, that okay, whether like how I filed by yesterday, that is due date, whether my supplier filed or not. And it may happen that out of 100 suppliers from whom I'm buying different things, 10 of my suppliers have not filed the return. So that I will get to know only in the subsequent month when I check my GST returns. Now this is where subsection 2 will come into picture. We will come back to subsection 2 because we have a similar condition in 16 subsection 2 clause C also. So when we go to 16 to C, we'll come back to subsection 2. So, but just I wanted to give you a connected feeling that 16 and complementary condition is in 41 also. So 16 entire section, 17, 18, these three together decide what is eligible credit. Then 41 one says this eligible credit, you show it in your returns and it will be added to your credit ledger. But remember, it is not final, it is temporary, it is self-assessed. Now, along with this, we have different rules which we need to check because different rules have given different conditions, 36, 37, 37A, etc. So we'll study all this. So best is we come to the analysis part, because analysis part will cover one provision along with the relevant rule, along with the relevant circular notification, everything at one place. But remember, what we are studying now is the conditions of 16 along with the relevant other sections, rules, notification, etc. Correct? Anybody, any questions or doubts up to this point? No questions? Perfect. Now, 16.1, the eligibility as we studied was that you should be a registered person. Only then we allow you to take credit. Now, besides that, there is nothing else, nothing very special. Once you are a registered person, credit is allowed. But in the same section, the other criteria or condition is that the goods should be used for your business. Now, this is a phrase which is used throughout the GST law in the course or furtherance of business. That is what is simplified to say. You should be using the goods or services for your business. Until and unless the goods and services are for business, your amount is not eligible as ITC. Now here the important word is used or intended to be used. So that is what is important, that intention to use is also relevant. What is the difference between use and intention to use? See, it may happen that something I have bought which I am going to use immediately in my business, something which I have bought, but it will be used after 6 months, after a year, but I have the intention of using it in business. I have no other intention. Example, I have bought a spare machine, or we call it as the standby machine. What is a spare or a standby machine? It will not be used normally, but it will be used if my main machine breakdowns. Now, my production process is such that I cannot stop it. Otherwise, my business would be affected. Let us say I'm a newspaper printing press. Now, if my press stops printing, then my tomorrow's edition will not come up. I cannot afford that. I cannot say, okay, if it is not printing, I'll wait for 1 or 2 days, I'll repair the machine, and after that, I'll give you newspaper for all the 3 days combined. Nobody will buy. So I need to bring my newspaper tomorrow early morning itself, and it should reach your doorsteps. So my printing should get complete midnight. My dispatch will start midnight. It will reach to respective cities in the morning 4 or 5, and it will go to the news vendors, and it will start reaching your houses from 6, 7 onwards. Now this entire thing requires that my printing press never stops. For this, what every printing press does is, besides the machines that they are using regularly, they have standby machines. For every activity, they have one standby machine, so that if any of their machine stops functioning because of any breakdown or any problem, they immediately put this machine in that place. It may take some half an hour for doing this shifting, but at least their paper doesn't stop. So that is what is a standby machine. Now, standby machine, when I'm purchasing, I'm not using it. but I have the intention of using it business. It may also happen that in next 10 years, I may never use it because my main machine never broke down. But still I am eligible for credit because it is intended to be used. What is very important is actual usage is not seen. If it is actually used very well, even if not, you have to just prove that the purpose of this particular asset was, or the purpose of this particular goods or service was using for business. Now we start with some practical issues. Molds and dies provided by original equipment manufacturer to component manufacturer on FOC basis, whether not considered as being in the course of furtherance of business. What is this? See, if you remember, we discussed this point in a previous chapter also. What is that point? I am the original equipment manufacturer. I am OEM, but I want the product. My product, if you remember, the example which I had given was Honda car. So I am a Honda company. My final product is Honda car, but it requires multiple small products. Now these small products I get manufactured from different industries who are called as component manufacturer. And when I'm getting it manufactured from you, I will give you my mold and die so that whatever product you are manufacturing and giving to me, which is this small part, that product will be exactly matching my requirement. So I give you that mold or die, which you will be using for making the product, making that component, and that will be given to you on FOC basis. FOC basis is free of cost basis. Now here the question was, I am purchasing that particular mold or die, which I am giving it to you free of cost. So whether it will be said that I am using it for my business, the answer is yes. Because when it says use for business, it does not mean that I should use it myself. Even if I am giving it to you, you are using it in the making of component, and the component is finally coming to me for being used in my final product. So indirectly also that mold or die is getting used in my business. So this is what is clarified in this particular circular, that it is not necessary when they are saying that it should be used, it means I should use it myself. Here I am giving that mold and die to you. Even if you use it and you use it for making my product, ultimately it is being used by me only, and I satisfy this particular condition. Correct? So what it says, mold die is owned by the original equipment manufacturer, which are provided to component manufacturer on free of cost basis, does not constitute a supply as there is no consideration involved. Further, since the molds dies are provided on FOC basis by the OEM to component manufacturer in the course or furtherance of business, there is no requirement for reversal of ITC. Why? Because it is provided in the course or furtherance of business. So indirectly they are saying that it is indirectly used for the purpose of my business. So the condition or the point that we are discussing is that these items are eligible for ITC only when they are used in my business. So what is being clarified here is that it is not necessary that I should use it myself. Even if I'm giving it to you on free of cost basis, you utilize it indirectly, it is being used for my business and I am eligible for this ITC. Now we come to 16.2, which provides the restrictions and conditions. What are these restrictions conditions? There are, as on date, 6 different conditions. Originally, there were 4. Later on, 2 different clauses were added at different points of time. So now there are 6. We will go clause by clause, and each clause of this section, along with the connecting rule, connecting circular, will study all together so that we get a comprehensive understanding of each point in detail. First condition given in 16.2a. What is the condition? You will be eligible for this ITC only when you have the tax paying document. What is a tax paying document? The list is given in Rule 36. So what are tax paying documents? Tax paying documents are those documents which is a proof that this particular input, this particular capital goods or input service that you have got in your business, whatever the tax was there has been paid. either paid by the supplier or you are paying it yourself under RCM, but it has to have some documentary proof. What is the documentary proof? First, it is the invoice or revised invoice of the supplier. So where the tax is paid by the supplier, it is the invoice of the supplier. Where tax is paid under RCM, it is your own invoice. So for RCM transactions, you have to prepare invoice on yourself, because if your supplier is unregistered, he won't be giving you any invoice. So first two are invoices. Third is the debit note. So where there is original invoice, but there was some mistake in the invoice because of which less amount or tax was charged. Now the supplier wants to increase that amount of tax. He will give you the document called as debit note, which will increase the tax. Third is in case of import transactions. The document is bill of entry. Fourth is whenever the case is of input service distributor, you have an invoice given by the input service distributor, which becomes the basis of getting the credit. Now here, I'll take your 5 minutes time to explain you what is this input service distributor concept, though we are going to see that in detail later on when we have a specific section on input service distributor. But since the point has come and it may get repeated at 2-3 places, we will just in 2 to 5 minutes, I'll try to explain you what is input service distributor. Now, this concept has come from the service tax era. During the service tax era, it was found that there is a possibility that there is one person having multiple units, multiple branches, which may have taken separate registration. Like this was more common in the excise era, because in the excise era, it was compulsory that you take separate registration for each factory. So now let us say I have my 6 factories for which I have taken 6 registrations as required by the excise law. And I have one office, which is the common office, which is managing all these factories. Many times it happens that I will have one corporate office. Like today, you see all these big business groups, they have one corporate office, which is either located in Bangalore or in Delhi or in Mumbai. And all their units, all their actual manufacturing, all their godowns are spread across India. Their entire management administration is done from that one office. Now, this office is only doing management administration. In other words, it is not making any outward supply. Understand this. My outward supplies are made by all these factories or units where actual manufacturing is taking place. This particular office, this head office, is only an office for doing the administration and management. Now, in this office, for running this office, I'm incurring many expenses. So I'm paying rent for that whole premises on which GST is there. I've hired professionals, I'm paying them professional fees. I've hired lawyers team, I'm paying them legal fees. On all these input services, I'm paying GST. All these GSTs coming and sitting in the credit ledger of this office. Now, since this office is not having any outward supply because it is only doing management, the entire credit which is coming and sitting in this office is as good as wasted, because I cannot use or utilize this credit. I can only avail and keep it. Availing and keeping does not give you benefit. Actual benefit is when you set off this against your output liability. Now, since I do not have any output liability, this credit is going waste. So, during the service tax excise era itself, the lawmakers came up with the concept that you take a separate registration for this office called as the input service distributor. So the name itself suggests that what this office will be doing, that whatever credit has come on your input services, which is lying idle in this office, that credit you will distribute to all your other branches. So the first step will be that you are getting all the invoices in the name of this office, which is your input service or input service ITC. This ITC balance every month you will divide, you will distribute amongst all the units, so that whatever ITC was there with you will now get divided to all these units. So your ITC balance becomes 0. And now this ITC goes and sits in the credit ledger of these units. Now, for all these units, you will be getting the ITC share of this common expense which had come to this office. Now, this office, I am calling it as your corporate office, your head office. There is no compulsion, nowhere in the law they have used the word head office or corporate office, but generally it is the head office or corporate office where all these invoices have come. These invoices are of common expenses. Common means it is applicable to the company as a whole. It is not related to any particular entity. It is common expense, and this common expense ITC is distributed to all of you all in a suitable ratio. That is where this office gets a separate status called as input service distributor. Now, when you have to take the share of this common ITC, how you get this share? I am distributing it to every one of you by using some document, which is actually again an invoice prepared by me. So I prepare an invoice, and using this invoice, I transfer, I divide, I distribute this common ITC. That is what is the document they are talking about. Is this clear to all? Yes. Now they are saying your invoice should have these common details. Please read it by yourself. I'll just have 1 minute small break.
Sir, I will take the self-assessment only after I receive the statement from the supplier.
I didn't get your question, beta.
I will, sorry, I will avail this input text. I will avail the ITC only after I get the supplier's document.
Yeah, because that is your first condition, na? So
Okay.
the first condition is you should have the supplier's invoice. So let us say you have received the goods and service, but for the time being you do not have the invoice. So until and unless there is an invoice, you cannot take the ITC. Now the invoice may be in physical form, the invoice may be in electronic form. That makes no difference. Correct?
But what is saying GSTR 2B? What is its role?
That we are coming. That we are coming. That is my second question. That is my second condition. Fine. Okay. Now,
Okay.
the first condition was you should have supplier's invoice. Now, technically, this condition is required only at the time of GST audit, because today nobody comes and sees whether you actually have the invoice or not. This will be known, or this will be actually required when any audit happens, and at that time, for every input tax that you have taken, the officer will say, okay, show me the proof. The proof is the invoice. But then what is your immediate proof? That immediate proof is what is now included in the law by way of this newly introduced clause AA. This clause was made effective from 1st of January 2022. if I'm not wrong, with the date. It was made effective from, can you see the date somewhere? Okay, we will get the date somewhere. Now, this clause, as you can see, double A, this shows that it was not there originally. It was later on introduced in the law. Why it was introduced? For the simple reason that whatever other condition that we are checking, what is the proof that actually this particular credit has come to you? Now understand this. Originally, when the GST law was designed, there were supposed to be three returns: GSTR 1, GSTR 2, GSTR 3. Now, what was the return design? That when supplier files his GSTR1, so you are also filing your GSTR1 in which you are showing your sales. Similarly, supplier is also filing his GSTR1 showing his sales. When he shows his sales, which is made to you, and he uploads his GSTR1, that amount will reflect in your GSTR2A, and you would be given the option of either accepting, rejecting, or modifying that particular entry. This was the originally designed return. However, the portal did not support that and the return failed. So they removed this concept of 1, 2, 3 and they brought 1 and 3B. So you file your outward return in 1 and then directly you jump to 3B where you check, not check, sorry, where you show your outward also and you show the entire ITC also. Now here, over a period, the government found that when I am directly coming from 1 to 3B, that I have missed or I have skipped that entire GSTR to Y because it wasn't functioning. This was creating a practical problem that when people were filing their 3B, the ITC that they are claiming, which is their benefit, which will reduce their output liability, they are claiming by themselves directly in 3B without any cross check. So the government thought, let me try to restart this GSTR2 concept. It cannot be restarted now because that has been removed from the law. But if you remember, I mentioned that when the supplier files GSTR1, whatever sales he is showing in his GSTR1, if the sales are made to you, it auto-populates in your portal in GSTR2A. So 2A is like your purchase return. One is your sales return, 2A is your purchase return, but purchase return not created by you, but the purchase return created automatically. That is why it is 2A. A stands for auto-populated. Now, when the supplier uploads his sales in the GST portal, putting your GST number, the GST portal matches that, okay, this is of Vishal Podar because the GST number is put of Vishal Podar. It will extract those invoices from the supplier's GSTR1 and show in my auto-populated purchase return, which is GSTR2A. This 2A existed right from day one, but it did not have much relevance. Then there was a lot of dispute, there were a lot of challenges. So the government said, okay, let me also bring one more auto-populated return, which is GSTR2B. So presently, whenever my supplier files his GSTR1, which is his sales return, showing sales made to me, which is my purchase, it gets auto-populated in my GSTR2A also and 2B also. Now, the only difference is 2A was the old form. It had the old detailings. 2B, they have devised a new form with more detailings which are required for today's requirement. Now 2A is also there. They have not yet stopped 2A. I believe it will still continue. But you also have this 2B and now they brought this condition in the GST law which says that now you will check your 2B every month to find out what are the purchase details. Just give me a minute, students. Now, so now the present position is that let the supplier file his GSTR1 showing the sales. Now the portal has inbuilt mechanism to tell you that yes, supplier is showing that sales made to you, which is an implied proof that you have made the purchase. And now they have put this condition that you can avail the credit only if it is reflecting in your GSTR 2B. So as I said, first condition is still there, but first condition, who will come and check whether you have the invoice or not today? This will be required only in the future when the physical audit happens. But today they wanted a cross check which the portal could check. Now, understand one thing, students, as we will proceed with this chapter particularly and the other chapters, you will understand and realize that slowly and steadily GST is moving towards automation, which means that now over a period, officers would be required only for the technical part of GST. For all these procedural part, the portal would be doing everything. Like the condition that whether the supplier is making the sales to you or whether the purchases which you are showing is genuine or not, how it will be proved? It will be proved when it is matched with the sales shown by supplier. And this the portal is now going to do because of this new condition introduced in the law. Now, because of this condition, suppliers upload his GSTR1, his sales details, which gets auto-populated in your GSTR 2A and also 2B. And now let me tell you how the automation is proceeding. This 2B, which is your auto-populated purchase details, is getting auto-populated in your 3B. So 3B, which is your final return, in which there was a time when we were punching in the purchase, that is the ITC details by our hand. Today we are not punching. 3B is now getting auto-populated. How? See, 3B is my final return, which shows my output, input, and the difference and shows me the final tax payable. This entire detail is getting auto-populated in my 3B on the basis of my two returns. First, I have also filed my GSTR1 in which I have shown all my sales. All these sales which I have shown in my GSTR1 are coming from my GSTR1 automatically to 3B in the sales or the outward part. And whatever are my purchases which are shown by my respective suppliers in their GSTR1, which gets auto-populated in my GSTR 2A and 2B. From 2B, it is also getting auto-populated to my 3B. So now my 3B is having all figures auto-populated. Only I have to add one figure that is of RCM, because that is where the tax I am paying by myself on my inward supplies. And maybe because my supplier in most of the RCM cases is unregistered, he will not show any GSTR1. He's not filing any GSTR1 because he's unregistered. So that is not getting auto-populated in my 2B, also not getting auto-populated in my 3B. So that is the only figure which I will add. Otherwise, my 3B is complete. Now, there is a step further now. For your purchase, you have auto-populated 2A, which is only for viewing. You have auto-populated 2B, which is for more detailed viewing. What are those details? That I'll explain when we proceed. Now, recently, since only last 2 months, they have introduced one more concept, which is called as IMS. Anybody knows the full form of this new concept, IMS? Students, anybody from you knows the concept of IMS? Okay. Your articleships are going on, na? Or you're on leave? I thought your articleships are still on because your attempts are in May. IMS is invoice management system. Now, If you remember, I just mentioned when I started explaining this that earlier there was GSTR 1, 2, 3. Supplier uploads in his GSTR 1, it will reflect in your 2A. And in 2A, you are having the option of accept, reject, modify. Later on, the system failed. So 2A did not have this option. It was only showing what supplier is uploaded. So they switched to 2B, which is showing more details. What are the details? I'll let you know later when the point comes. Now, they still wanted this accept, reject concept. So now they have introduced the third return or the third purchase return, you can say, which is IMS. So now when supplier uploads his GSTR1, it reflects in your 2A, it reflects in your 2B, and it reflects also in your IMS. In this IMS, against every item which is reflecting, you are given the option of accept, reject, pending. What is the option? The option is accept, reject, pending. Now, this option of accept, reject, pending, which is appearing in your in your IMS, is now the crucial factor because till date, it was only appearing which you were watching in 2A. It was appearing in your 2B, which was getting auto-populated in your 3B, which also you were watching. But now, after the introduction of IMS, you have to take action. Action of what? Now you watch these getting auto-populated in your 2A, 2B, and also IMS. But now you have to say, yes, I agree to this. Accept, 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 accept. And where you feel some invoice is not related to you, it has wrongly come in your portal. And it happens because somebody while uploading the invoice has wrongly put your GST number. It may happen. Or the invoice is having some defect or there is some problem and you don't accept that invoice. You have the option of decline or reject. So now that is what is the new functionality brought in just 2 months before. I believe it is not going to be part of your exams for the simple reason that one, it is recently introduced, and secondly, it has not been yet made compulsory even practically. That is, we are also still having, you can say, a trial period of that. So that is why definitely it is not part of your exams, but just to inform you, because the moment you come out of your exams, you'll find the IMS working full-fledged. So the point is that now this condition requires that there has to be month-on-month matching. That supplier should show his sales, then only you get the ITC, because only then this purchase becomes a confirmed purchase from your end. Is this clear? Whatever I've explained on this entire point. Anybody has any questions or doubts, please feel free to ask.
Sir, you said that there is an option of accept and decline. If someone decline, then what is the impact who upload that invoice?
Now see, let us say you have uploaded invoice. Hemant has uploaded. Everybody of you have shown in your sales return invoice to me because you all are showing sales to me. However, in this month, the sales shown by Jeannie is not related to me, but somehow by mistake, she has put my GST number. So it is coming in my GSTR 2A, 2B, and also my IMS. Now, if I feel that since this is not my invoice, I am not eligible for this ITC, I'll press the decline or the reject button in the IMS. The moment I press this, it will be removed from my GSTR 2A, 2B all details because it is not belonging to me. It will not go to my 3B. And most important, it will give immediate intimation to my seller because seller has filed his GSTR1 showing the sales to me. So Ginny has filed that particular invoice showing sales to me. But since I am claiming that no, it is not my invoice, the moment I cancel it from here, decline it from here, Ginny will get the intimation in her GST 1A that I have rejected her invoice. So she will come to me. So she will come to know that yes, either she may have made mistake why I have cancelled, or if she feels no, she is still correct, she will call me. And in that case, now once I have rejected, it is gone. She will have to raise another invoice in that case. So that will be a more tedious process. But just to inform you all that this is how this IMS has been designed. So answering your question, what will happen? The moment I reject, it will go back to her, and in her portal, it will show as rejected. So that to that extent, her sales get reduced, and this will not be appearing as the sales invoice for her also. I hope I've answered your question, Bida.
Yes, sir.
Perfect. Now, so what it says, ITC in respect of any supply of goods, service, or both can be taken by the person only if the details of this invoice debit note in respect of the supply has been furnished by the supplier in their statement of outward supplies, which are GSTR 1 or amended 1A or the IFF. These are different ways how supplier uploads his outward supplies. And such details have been communicated to the recipient. So once he uploads, it will be communicated to me. How? In my GSTR 2B. So I will get these details in my GSTR 2B on the basis of the GSTR 1 filed by the supplier. Now the supplier may be a monthly filer or a quarterly filer. The supplier in quarterly file may be following the QRMP scheme. All these schemes and all these options you will study in the returns chapter. And on the basis of whatever the person is uploading in his GSTR1, or if he is a quarterly filer, he is given this facility called as invoice furnishing facility, where he can upload the invoice every month. So whatever he is uploading, that is what is reflecting in my portal in my 2B. And on the basis of this 2B, I will come to know that, okay, these are the purchases which my suppliers have shown. Now, there is a possibility that there is some purchase which I have made, but my supplier has not shown because he has not filed his GSTR1, or he filed his GSTR1, but he forgot to show my invoice. That will not reflect in my 2B. And as per this new condition, I will not be able to take the credit of that invoice at least in this month. I will make a follow-up with my supplier, ask him to upload it, and whenever he uploads it, it will be now available to me in the next month. So until and unless now my supplier uploads it, I cannot take the credit. That is the impact of this new condition. Now, what is this new form 1A? 1A is a form wherein a registered person at his own option amend or furnish additional details. Now, what will happen? He has furnished GSTR 1. After furnishing GSTR 1, it appears in my 2A, 2B. And as it appears in my 2A, 2B, I get to know that, okay, this is what is appearing in my 2A, 2B is not having few invoices, or a few invoices are having some corrections. I immediately inform my supplier that, okay, you have not uploaded my invoice, or there are some corrections in the invoice you have uploaded. What is the option he has? He can go to his GSTR 1A for making the corrections and amendments. So 1 is his first or the main sales return. 1A is the sales return given to him for making the corrections, if any, where he has made the mistake in his GSTR 1. So 1A will help him to amend or furnish the additional details of outward suppliers of goods or service after furnishing the details of outward supplies in his GSTR 1. So he filed 1, it auto-populated in my 2A, 2B. I checked it, I found some mistake. I informed him, he does the correction in his 1A. And once he does the correction, it will be again auto-populated in my 2A, 2B, but it will be auto-populated now in the next month only. So once there is some mistake from the supplier's end, it will be corrected by the supplier in his 1A, but I will get the credit only in the next month. Now, invoices on which ITC is not available. Why? Because it is falling under section 17.5, which we know it is a block credit section, which we'll be studying later, are not to be considered for claiming ITC even though they are furnished by the supplier. Means what? The supplier furnished it. Why? Because you gave the GST number. It is auto-populating in your 2A, 2B, but you have to know that if it is 17.5, means it is blocked, you are not allowed to take credit, but it is auto-populating. So what you have to do is, when you are filing your GSTR 3B, it is coming auto-populated from GSTR 2A, 2B to your 3B. You should reverse that credit so that ultimately you have not availed it. Because if you avail it and if you utilize it, it will become a default and you will be liable to interest penalty. On the other hand, full ITC can be availed in respect of IGST paid on imports, documents issued under RCM, credit received from ISG, which are outside the ambit of 37.1. So these are not part of 37.1 means supplier of these items are not uploading anything in the portal, but you can claim it by yourself and it will be allowed to you. This is what is the second condition.
So what is ISD, sir?
Arey beta, ISD is input service distributor. Na, I explained you at the start. Na? ISD we just discussed, na, head office, multiple
Okay,
branches,
understood, sir.
common credit. The
Understood.
short form of input service distributor is ISD. Fine.
Yeah, yes, sir.
Okay. Now coming to the third condition, which was there originally, just they added few clarifications to this. Now, what is the third condition? The third condition is in section 16.2b, which says that the registered person, if you are taking ITC, you have to ensure that you have actually received the goods or services. Now, there are few clarifications, few issues relating to it. First, most important clarification is the bill to ship to model. What is this bill to ship to model? I am selling my goods to Hemant, but Hemant has to further sell it to Mitali. So Hemant says, okay, sir, the goods which I am buying from you, I do not want the delivery at my place. I want the delivery at Mitali's place. I say, fine, done. Now, in this particular case, I'm raising the invoice on Hemant, but delivering it at Mitali's place. This is called as bill to, which is Hemant, ship to, which is delivery, which is to Mitali. Now, in this particular case, Hemant, who is purchasing these goods from me, obviously wants to take credit. He satisfies the above two conditions. One, he has my I invoice. Yes, I have uploaded in my one showing Hemant as the buyer. It is reflecting in his 2A 2B. Hemant can check it in his 2A 2B. Correct. But the third condition, which is this condition, is slightly problematic for Hemant because physically he has not received the goods. The goods have physically gone to Mitali. Now, in this particular case, the practical challenge created or the practical challenge that was appearing was that if he has not received the goods physically, can he still claim the ITC? The answer to this is yes. Why? Because it has been clarified in this particular section and condition itself that where it is a bill to ship to model, where on Hemant's instruction only, I have directly dispatched the goods to Mitali. It means when the goods reach Mitali, receiving the goods by Mitali would be considered as receiving by Hemant for the purpose of this section. In other words, in bill to ship to model, it is not necessary that Hemant should have physically received the goods, and it says it would be deemed that Hemant, who is my customer, has received the goods when the goods are delivered by me to another person. Who is this another person? It is Mitali on the direction of Hemant. So if I deliver the goods to Mitali on Hemant's instruction, then once the goods reaches Mitali, it will be deemed that Hemant has received the goods and Hemant would be deemed to have satisfied this condition. So whenever it is a bill to ship to model, physical receipt by you is not possible. So it has been excluded. Still, you are eligible to the ITC. I hope this is clear.
Excuse me, sir.
Yes,
If
beta.
in your example, if Hemant is also sold to me that
He
goods,
has sold to
in
you.
this,
See, there
yeah,
are two
then
transactions
I
in one
also.
transaction. I have sold to Hemant and Hemant is selling to you. That is why he is asking me to directly dispatch to you. Correct? Go ahead.
So, sir, can I, if I also want to sell it again to another person, can I, in this case, I also take input tax credit?
You
Third
will
party
take
is
now.
also.
See, you will take credit on the basis of Hemant's invoice
Yeah,
because
okay,
your
sir.
seller is Hemant. You don't even know me. You have only received the goods from me, but you don't know me, right?
Yes, sir. Okay.
For you, the seller is Hemant. Correct?
Yes, sir.
So
Okay.
you will also get credit on the basis of the invoice that you are receiving from Hemant. Hemant would have uploaded the invoice in his GSTR1. So in your 2A, 2B, Hemant's invoice is reflecting on that basis. You will take credit. And anyways, this third condition is satisfied because you have physically received the goods.
Yes, sir.
Correct? Okay. Now, relating to this same condition, we have another provision. So I have just scrolled down and come to that point because it is also relating to the condition of receipt. This point is given in the first proviso to this section. Now, what is this point saying? Many times it may happen that the goods that are being sent by the supplier to you are sent in lots. Now, I'll give you a very simple example of this. You are buying a windmill from me. Now, if you have seen the whole windmill, it is a huge pillar, and on that you have the huge wings which rotates with the wind and that generates the electricity. Now, if you're buying this windmill, it is that huge pillar, it is those huge wings, it is the generator equipment, it is the battery. There are so many things which collectively make one windmill. Now, I have to install it nearby your factory, the place where you have asked me to install it. Now, that windmill, when it will be dispatched from my factory to your place, it will be dispatched in multiple trucks by making small components of that, which is called as CKD or SKD. CKD is complete knockdown, SKD is semi knockdown. So what I do is I make small parts of that entire pillar, entire wings, so that it can be loaded, it can be transported in one truck. So it takes total 10 trucks to load your entire one windmill. Now, I am selling you this windmill. But this windmill, since it is loaded in 10 trucks by making parts of it, it will reach to you one by one. Now understand this practically. Today it is 21st of December. I upload this particular thing, and once it is getting uploaded, I make the truck move. So the first truck left my factory today. Second truck also left by evening. Then the third truck comes, I upload the next part. Fourth truck, fifth truck, they leave tomorrow. Sorry, tomorrow is holiday, so no truck leaves tomorrow. Then comes Monday. Monday, Tuesday, few trucks leave. Again, there is 25th holiday, Wednesday. So this is how during the next whole week, these trucks start leaving my place after getting loaded with one part of this windmill. And they start reaching you also in stages. Now, the first truck which left my place today, first and second truck, they reach you on 29 December. The second truck reaches you on 31st, second, third, fourth truck. And the remaining truck reaches you after 1st of Jan. I sold it today itself. I raised the invoice. I uploaded in my December return. It is also appearing in your 2A, 2B of December. But you will not be able to take credit when you are filing the December month's return. Why? Because of this condition. This condition is given in the first proviso to section 16.2. What it says, you will be eligible to take credit only when you receive the last lot. So even if out of 10, 8 trucks may have reached you by 31st of December, you cannot take the credit in 31st of December. The entire credit of this entire windmill, you will take only when you receive all 10 trucks. So until unless the entire consignment reaches your factory, reaches your location, you cannot take the ITC. That is what is the condition coming out of this first proviso. Is this clear to all? Is this condition clear?
Sir, here last lot means according to that invoice what we raise.
I did not get your point, Bida.
Sir, if like I order in a bulk, I order some raw material in bulk,
Correct.
right? So I make a invoice for one invoice for
Correct.
that. then it's included all that one invoice, right? If I want to take credit, I have to make a different invoice for that.
Correct. So if you want to take credit, you should make different invoice. But as I gave you example of windmill, there will be only one invoice because it is one windmill.
Okay, sir.
Correct. So that is why I purposefully gave you example of windmill. So windmill, it cannot be split into 10 invoices because it is only one product. Correct. I have to dispatch it in 10 trucks because of the size and the hugeness of that particular thing. But invoice will be one. So that is why this law is created. When the invoice is one, you will get the credit when you receive all the lots of that particular one invoice. So in my example, since the last 2 trucks reaches you in January, you will be eligible to take the entire credit of the entire consignment only in the month of January. Is this fine?
Yes, sir.
So this is what is our third condition, that the goods or services should have been received by you. In that, there are 2 special scenarios. One is build to ship to, and one is when it is delivered in lots. Now coming to the next very recently amended condition. This condition is brought in by way of clause BA. And what does this condition says? That now the first conditions are satisfied. You have invoice. I have uploaded the invoice in my one, so it is reflecting in your 2A, 2B. You have also received the goods and services. But still, despite of satisfying all these conditions, you will not get credit if the credit is blocked by this new section 38. I repeat, you will not get the credit if the credit is blocked by this new section 38. Now, 38 is not a new section. It was already there in the law. But when they amended, when they introduced this BA, the 38 was anyways a defunct section at that time. So they erased the entire original 38 and they brought in a new 38 in that place. And now the section says details of ITC in respect of the said supply, which is communicated to you. So you have satisfied the above condition. It is communicated to you means you are seeing it in your 2A, 2B. But under 38, it should not get restricted. In other words, if it is getting restricted in 38, if it is getting blocked in 38, you will not get the ITC. So indirectly, they are saying, now go and check 38 that whether you are also complying with 38. If you are not complying with 38, your credit will be disallowed. So for getting the credit, you should have also satisfied the condition of section 38. This is what is the point number D. Now, what is 38? They have reproduced over here. Important point is 38 has not yet become effective. How it has not become effective, I'll explain. But firstly, what they are saying, what is in 38? So in 38, section 38 stipulates that the details of outward supplies furnished by the supplier in 1, also amended by 1A, if any, or using IFF and auto-generated statement 2B contains the details of ITC is made available to the recipient of supply every month. So this we have studied up till above. So he files his 1 or amendment done in 1A, everything, and it gets auto-populated in your 2A, 2B. Now, till this point, you have satisfied the above conditions. Now, what is this condition? It says you should not be restricted by 38. Now, what are the restrictions of 38? That is given further. What it says, 2B contains the details of inward supplies on which ITC is available as well as on which ITC is not available. So now the 2B will, if you remember a few minutes back, I had mentioned that what is the difference between 2A and 2B? 2B is giving more details. What is this more details it is giving? It is giving you details of what ITC is available to you and what is not available. So now 2B, why it is referred? Because 2B is giving more details and 2B itself is giving you details whether your ITC is eligible or not eligible. Now, ITC will not be available in respect of those inward supplies the details of which have been furnished by the supplier. So supplier has furnished details, but still it is saying ITC will not be available. Why it will not be available? The conditions are given in section 38. In other words, 2B will show all these invoices as ineligible or unavailable. What are these invoices which are appearing in your 2B? It means supplier has uploaded, but still 2B is saying I will not allow or I will show it as unavailable. Who are these? First, where the supplier has newly registered. Now, the first condition where 38 will restrict your credit is where the supplier has just registered in GST. Then there would be some specified time period. Up to that time period, let us say first 1 month, 2 months, 3 months, the supplier will, if he is registered for the first 2-3 months, you will not be getting the credit of such new supplier. Now, this period, what will be this specified period is not yet notified. So as I said, this 38 has not yet been notified. What is not yet been notified? All these details. So first, where the supplier is a newly registered supplier and what is the period till which you will not get credit, they said they will specify. It is yet to be specified. Second, you will not get credit of that supplier who has defaulted in payment of the tax. So if the supplier has not paid the tax in his return, you will not get ITC. Then whose output tax, which he is showing in his GSTR1, exceeds the output tax which is appearing in his 3B. So many times what supplier do, they show everything in one, but while filing 3B, they reduce the output liability in 3B and pay less tax. So if the supplier output liability shown by his GSTR1 is more and what he is showing in his GSTR 3B is less, it means he is doing some fraud, you will not get credit. Then who has availed ITC of an amount exceeding what is appearing in his 2B. So supplier is taking excess credit. Then what is appearing in his 2B, again you will not get credit from him. Or who has defaulted in discharging his tax liability in accordance with provisions of 4912 read with 86B, that is who has discharged more tax liability from electronic credit ledger than prescribed. So it means he should be utilizing his credit ledger correctly. If he has wrongly utilized his credit ledger, still you will not get credit. Or last is other specified class of person. So see, this is the list which is given in 38, where if your supplier has done any of these faults, I will not give you credit. So interestingly, or rather shockingly or strangely, supplier is doing wrong, any of these wrong, you don't get the credit. And this is the most riskiest part of this particular new section 38. The better part of this is that this is not yet made effective. Why? Because all these specified, prescribed is not yet prescribed. So till they are not specifying or prescribing these details, for the time being, you all are safe. The moment these starts getting prescribed, getting ITC will be difficult. So even though it is appearing in your 2A, 2B, every other condition is getting satisfied, but because of 38, it may still get blocked. Have you understood this condition? This new condition inserted in BA?
Any idea, sir, when it will be effective from?
This was introduced last year. It should have been effective. So around a year has passed. And I'm sure they are also maybe reconsidering it, because the moment they make this effective, you can understand how difficult it will be for a businessman to actually do business. Because understand one thing, in all these things, your supplier is doing something wrong. Now, how can you control your supplier from doing wrong? You don't even have any access to his books or what he is doing. Correct? Now, if he does any small mistake and your credit gets blocked, it is such a big problem for you. Your supplier may be in some other state, maybe some 1,000 kilometers away. You cannot go and catch his collar and make him do the correct thing. So you suffer for your supplier's mistake. That is the deadliest part of this section. And that is where
Lot of cases will come, I think. Lawsuits will come.
Correct. So that is why they have not yet notified it.
Yeah, understood, sir.
Correct?
Yes, sir. Yes.
Great.
Sir,
Chalo.
they say that input tax credit is blocked. So, at what time? There is some specific time that, how he
See, what
get
will happen? See,
back?
all these things you come to know in the next period, right? So this month's
Okay.
return we all file. Your supplier is also doing something. So you get to know it in the next period. See, few things you'll go get to know immediately. Like if your supplier is a new supplier, you get to know immediately. In your 2B itself, they will show that this supplier is not correct. So either it will show in the current 2B itself, or you'll get to know in the next 2B, and the 2B will ask you to reverse it. So that is what I'm saying. This section is going to be very tragic. So some of it will be reflected immediately. Some of it you'll get to know in the next period. Correct?
Yes, sir.
Chalo. Chalo. We take a break, 15 minutes. Then we go on with the further conditions. We have some very interesting conditions coming up. Fine. So break for 15 minutes. The fourth condition, which is also you will see in section 41 bracket 2, is tax leviable on supply should be actually paid to the government. Now, in all the above conditions, the supplier had only uploaded the GST, uploaded the invoice in his sales return. It reflected in your 2A. So it only matching was complete. Now, this by itself was not a proof that supplier has actually paid the tax also. For that, they have introduced this condition to ensure that whatever supplier uploaded, has he actually paid the tax or not? Now, this condition is there right from day one. However, this condition got lot of criticism. Why? Because when I'm making purchases, let us say I'm making purchases from who's this new student? Rahul. So let us say I'm making purchases from Rahul. Now, I have paid the amount to Rahul, the value, the tax, everything. But Rahul does not pays it to the government. How am I at fault? Correct? Students, am I audible? Students, am I audible?
Yes, sir.
Okay. So I was saying this, that I have paid the amount to Rahul, but if Rahul does not pays it to government, how am I responsible? But this section 16(2)(c) required that I will get ITC only when my supplier has paid his taxes, and how he has paid, either in cash or by utilizing the ITC which he is getting. Now, since, as I said, this condition got a lot of criticism, they introduced this section 41, and in 41 subsection 2, they reintroduced this condition but with a change. Now, what is this change? As we just read 41 at the above, it is saying that firstly, we are giving you this ITC on self-assessment basis. Fine. It means what? For the time being, you take the ITC, but it is not final. Why it is not final? Because we are waiting for the supplier to pay the tax. Now, understand this point. In this month, in the month of December, I made purchases from Rahul. He gave me invoice. I made him payment. Everything is done. Now the next month starts January. He uploads the sales in his GSTR1. It starts reflecting in my 2A, 2B. I take the credit in my 3B. I am happy that this transaction is complete. But immediately after the due date of paying tax, that is 20th of January, is over, on my portal, I get to know that Rahul did not file his 3B. Now, if he has not filed his 3B, it means he has not paid the tax, because tax payment is through 3B. Now, if Rahul has not paid the tax, for me, 16(2)(c) is not satisfied, and I was required to reverse the tax immediately. However, as I said, that because of lot of criticism, this section is now saying that if supplier has not paid tax, I will not get trade, but subject to provisions of 41. So now 16(2)(c) has got a new partner in the form of 41 subsection 2. So firstly, subsection 1 says that whatever is the eligible ITC, you take the credit in your returns, which is on self-assessment basis. Now it says that now check if supplier has paid tax. If Rahul has paid tax, my problem or my point is over. The transaction is closed from both ends. I take ITC, I get ITC, and it is full and fine. But what if I get to know after the due date of return that actually Rahul has not paid the tax? In this case, the credit which I have taken becomes questionable, because it will now be not eligible because of 16(2)(c). But I am not required to reverse it immediately. This is the new change because of the new section 41 bracket 2 read with rule 37A. So what it says, if my supplier has not paid tax, that is if my supplier has not filed his 3B, then I am not required to reverse the tax immediately. which was the original 16.2c, which had a lot of criticism. Then what I'm asked to do, I should make follow-up with my supplier, and I should be behind my supplier, making follow-up constantly, calling him up, putting mails, making him file the GST return. Now, if my supplier files the GST returns at least by 30th of September following the end of the financial year. So this financial year is ending in next 3 months, that is by 31st of March 2025. And after that by 30th of September 2025, if any period up till then, Rahul files the GSTR 3B, it means he pays the tax. My role is over. My credit which I have taken, which was till now self-assessed temporary, will now be final. However, if Rahul has not filed his 3B and that is not paid the tax even up to 30th of September 2025, then I will have to reverse the ITC which I took, and for this I am given 2 months. That is up to 30th of September 2025. I will be behind the supplier asking him to file his return, pay the tax. If he does, well and good. If he does not do this, then in the next 2 months, that is up to 30th of November, I should reverse the ITC. Now, this ITC which I am reversing, I can reclaim the moment my supplier files the return. So if he files up to 30th September, no need to reverse. My ITC becomes final. If he does not file it by 30th September, up to 30th November, that is in next 2 months, whatever returns I am filing, I should reverse the ITC in those returns. And then in future, whenever he files a return, I will get the credit. This is what is now the final status of 16.2c, read with the amended section 41, read with the newly introduced rule 37A. Any questions with this particular condition and the related provisions? Yes, students?
No, sir.
Sir, if the supplier doesn't pay at all, what is the remedy?
See, I have reversed the ITC, so it is now cost to me.
Okay. If it
So it is
doesn't
now
pay
my
at
cost.
all,
Yes, it is my cost now.
okay, sir.
See, government is never going to be at loss, because if he has not paid ITC, I have reversed the tax. So government is not at a loss. So it becomes my loss, because understand this, I have paid to Rahul 100 rupees for goods plus 18 rupees for tax. This 18 I should have got as ITC. I took ITC, but I had to reverse because Rahul did not file his returns. Now, if he never files his return, let us see, now he's absconding, he closed his business, whatever. 18 rupees is my loss. I have paid it to Rahul and still I'm not able to get the credit. So it becomes
Is there any legal remedy, sir?
See, legal remedies, you can always file a case against him. You can go to consumer court for recovering your money. But then, as we all know, it is all then uh, legal process. How much time it will take, when you will get it back, nobody knows.
Right.
That is how it is. Correct? Understood? And then the last condition, sixth condition is simple. For getting ITC, I should file my return 3B. So why this is important condition? Because I get ITC in my 3B only, or it is through my 3B that ITC comes to my credit ledger. So until and unless I file my 3B, ITC will never come to my credit ledger. So in order that ITC comes to my credit ledger, I should have filed my 3B. And the moment I file my 3B, I will be eligible to take the ITC in my credit ledger. Correct? Now, these are the conditions given in section 16.2. Now, there are some more conditions. First, proviso, we already discussed with the condition of goods should be received. If it is received in lots, I will get the crate only when all the lots are received. That is, the last lot is also received. Then payment for invoice should be made within 180 days. Now, what is this condition? The condition is if I have purchased the goods or services on credit, I have taken the ITC because all the above conditions are satisfied. But if this purchase is made on credit, that is not without that is without paying the amount, then there is a condition that I should pay this amount within 180 days from the date of issuance of the invoice. This is what is given in the second proviso of this section 16.2. Now, again, you have a rule 37 which says what? Where the registered person who has availed ITC on inward supply fails to pay to the supplier the amount towards the value of such supply. So I have not yet paid you and 180 days have expired, whether wholly or partly, along with the tax payable thereon within 180 days from the date of issue of invoice, shall pay or reverse an amount equal to ITC availed in respect of such supply, proportionate to the amount not paid to the supplier. So let us say I have purchased from Hemant goods worth rupees 1 lakh plus 18% GST. This transaction is on credit and it is now more than 6 months, 180 days have passed. I have not paid to Hemant. I will have to reverse this entire 18,000 after 180 days. Second, in this 180 days, I have made payment to Hemant of 50% of the price. So I have not paid entire 1 lakh plus 18%. I have paid 50,000 plus 18% of that. So balance 50,000 is pending. Now in this particular case, after the expiry of 180 days, I will have to reverse half of the credit. That is the proportionate to the amount which is not paid. So if I have not paid 50% of amount to supplier, then I will be reversing 50%. When I will be doing this? While furnishing return in Form 3B for the tax period immediately following 180 days. So the date when this 180 days expire, after that, whatever is the GSTR return which I am filing in that return, I will have to reverse this ITC. Now, where this 180-day rule is not applicable, that is, you need not reverse after 180 days. First, the supplies are under reverse charge. So it is a reverse charge transaction where I am paying the tax myself. Even if I do not pay to the supplier within 180 days, no problem. Second, Schedule 1 supplies. Anyways, these supplies are without consideration. There is no question of making payment. And third is we made an adjustment in valuation in section 15.2b where supplier's expenses have already been borne by recipient. Now, if supplier's expenses have been already borne by recipient, there is no question of recovering that amount from the recipient because already that much expense recipient has done. So obviously supplier recipient will not pay me that much amount. So in these three cases, payment is not required. In other words, 180 days will not be affecting me, and in these three cases I will not have to reverse the credit even after 180 days without payment. Then next simple condition is, this is specifically in relation to capital goods. So let us say I purchase a machinery of 1 crore which has GST component of 12%, so 12 lakhs. Now I have purchased machinery by making payment to the supplier of 1 crore 12 lakhs. In this particular case, when I am claiming this ITC, I have to ensure that in my books of accounts, I am only capitalizing 1 crore, not the 12 lakhs, that is the GST component. If I have capitalized in my books 1 crore 12 lakhs, that is along with the GST component, what will happen? I will be now taking depreciation on that 1 crore 12 lakhs. That is the GST component. I will be claiming depreciation. Now, if I'm claiming depreciation, that is a tax benefit with respect to the income tax perspective because that will go to reduce my income and the tax. So the GST law says if you are paying GST on capital goods and also taking it in the cost of capital goods for claiming depreciation, you will not get ITC of that GST paid. But if you have not capitalized that amount, then you get the ITC. So the point is logical. If you want to get the ITC of capital goods, do not capitalize it. Then comes the most crucial condition in all of these, that is the time limit. So all the above condition makes me eligible to take ITC. 16.2 says I should take ITC. But If I do not take the ITC, that is, I forget to show it in my 3B, it is not added to my credit ledger, that is, I have not taken or availed the ITC, then the law will not help me. The law is saying, I have given you the eligibility to take the ITC. Now it is up to you whether to take or not to take. If you don't take it, I am not going to help you any further. So they have given me a last date by which I should take this ITC in my 3B returns. If I fail to take it, that is, I do not show it in my 3B returns, it is not added to my credit ledger up to the due date, that much ITC I will lose. So what is the time limit for getting the ITC or claiming that ITC in my 3B returns? It is up to 30th November after the end of the financial year, or up to the date of filing annual return, whichever is earlier. Now the last date for filing annual return is this 31st December. So right now, many chartered accountant offices are working on filing their annual returns. If my annual return is filed before 30th of November, let us say I filed this annual return on 1st of November, then my last date for claiming the ITC was 1st of November. But practically everybody files it after 30th November so that they can utilize the maximum time. So by 30th November, I should claim the ITC in the 3B return which I have filed. If I fail to do that, I will lose that ITC as per the condition of 16.4, which is my time limit. Anybody has any questions up to this point?
Sir, you said that we have to pay within 180 days, right? So
Mhm.
it's a point of self-assessment, or there is any process to find out that payment is made or not?
Well, that is self-assessment, beta. Officer or department will come to know this only when they do your audit. Otherwise, there is no mechanism, at least in the GST portal or the GST return, for them to find out. So, in this particular case, the reversal of 180 days has to be done by your own self. Correct?
Okay, sir. Okay.
Should we proceed? Great. Now, relating to 16.4, there is a very interesting point. Now, what does 16.4 says? If my expense is of this year, that is financial year 24-25. So Hemant has sold goods to me, Mitali has provided some service to me, and I have received both persons invoice, which is of the current financial year, that is 24-25. Please understand this, we are talking about 24-25. Now in this particular case, sorry, in this particular case, 16.4 says that if the invoices of this year, I should claim this credit maximum by 30th of November 2025. Now in this, there is a slight variation. If let us say this expenditure is of RCM, where I have got some inward supply from Ginny, who is a lawyer, and since she is a lawyer, whatever is her legal charges, I have to pay tax myself under RCM because legal charges are falling in RCM. Perfect. Now in this particular case, the interesting point is that when we are talking about this RCM, there are two possibilities. One, my supplier is registered. Two, my supplier is unregistered. If my supplier is unregistered, then it means the supplier is not having any GST number. The supplier is not filing any GST returns, and also the supplier is not giving me GST invoice. In this case, we already studied above also, and we will study in the chapter of documents also, that in such a case, I have to issue invoice myself on myself. That is, the invoice which issued will be issued by me on me, because the supplier cannot issue invoice. So I have to make a self invoice. So first invoice is compulsory, but the invoice would be raised by myself. Now what is the interesting point? The expense of this RCM that is this legal charges, is of 24-25. That is the current financial year which is going on. However, I raise the self invoice in the financial year 26-27, after 2 years from today. So invoice, the expenses of 24-25, that is current financial year, I have taken the legal service from Ginny, but I show the self invoice, or I make the self invoice in the financial year 26-27. Now the interesting point that they are saying, that the relevant financial year for calculating time limit for availment of input tax credit as per this section 16.4 will be the financial year in which I have made the invoice, and not the financial year in which the expense has happened. So expense has happened in 24-25. If I take the time limit as per 24-25, my last date for claiming the credit would be 30th of November 25. But since here my supplier is unregistered, as per 31F, I have to make invoice myself, which is called as self invoice. This self invoice I make after 2 years, that is in 26-27. So my time limit for getting the credit will start from 26-27, and it will then become 30th of November 2027. So this is what is an interesting clarification that has been provided by way of circular. So this is an important provision, and as you can see, it is put in bold because it is very recently issued. Is this fine? As you can see the date, it is issued in this year itself, in June 2024. So this circular has lot of relevance. Now, another adjustment in this time limit is given by 16.6. Now, firstly, let us understand where this extended time limit is required. So let us say I am buying some goods from Mitali. Mitali has sold me some goods. These goods, Mitali has given me the GST number also. Everything is done. All conditions are satisfied. But now all this has happened in this month. So I should claim this ITC maximum by 30th of November 2025 as per the time limit given in 16.4. But what happens? Because of some default at my end, the GST department cancels my GST registration. So my GST registration is cancelled, let us say from the month of January 2025. Now, I have to take this credit maximum by 30th of November 25 as per the time limit we saw above. But since my registration got cancelled from January 25, I cannot file any returns. I cannot take ITC. And this continues till April 2026. That is for around 1.5 years. Now, in this particular case, if my registration itself is cancelled or suspended, because of which I cannot file the returns, how can I take the ITC within the time limit? So for such cases, they have extended the time limit for me, which says that consequently, relaxation has been given and the time limit to avail ITC, which is under 16.4, but in respect of invoice debit credit note is extended till the date of filing returns in cases where the return for the period from the date of cancellation of registration or effective date of cancellation of registration till the date of revocation of cancellation are filed within 30 days of revocation of cancellation. So my cancellation happened in January 25, and this cancellation was ultimately revoked and my registration was revived from April 2026. So let us say it happened on 15th of April 2026 that my registration was restored, revived. So I will now be filing all my pending returns after 15th of April, and they have given me 30 days. So if I file these pending returns within 30 days of revocation, of cancellation of registration, then I can take the pending ITC. So indirectly, my time limit under 16.4 has got extended. So what I was supposed or allowed to take by 30th of November 25 is now extended up to 15th of May 26 because my registration was cancelled next whole year. I'm not in a position to take the ITC because I cannot file the returns. So they have said that after revocation of my cancellation within 30 days, I should file all pending returns and take the ITC. Is this clear?
Excuse me, sir. Sir, in exam, we have to write exactly the same wording which is
Not at
given.
all. Not at all.
Okay.
You can always use your wordings. Only try to use section numbers, rule numbers wherever possible. And since this is an important chapter, I will request that you learn all these rule numbers because they are very, very important. Correct?
Yes, sir.
Perfect. Now we come to the next restrictions or conditions. The further restrictions or conditions are of section 17. So the next two conditions that are given over here are not of 16, they are of 17. One is 17.5 completely blocks your ITC, and the other is section 17.1 and 2 gives you ITC but not fully proportionately. So let us go to 17. Now let me give you an overview of 17, 17.1, 17.2, 17.3 and 17.4. These first four subsections, they give you ITC proportionately. Why proportionate? That we will discuss. And 17.5 says we will not give you ITC at all. So 17.5 completely blocks the ITC, whereas first four subsections gives you ITC, but they give you proportionately. So wherever there is any problem or default, okay, I'll not say default because it is not a wrongdoing at your end, but where you are fitting in any of these provisions, you are allowed ITC, but the ITC allowed is proportionate. And in 17.5, the ITC is completely blocked. 17.5 we'll discuss later. First, let us understand when and why ITC will be allowed partly. So basically there are two subsections only, 1 and 2, which gives you two reasons where your ITC will be allowed partly. What are they? Where the good service or both are used by the registered person, partly for business and partly for other purposes. The amount of credit will be restricted only to so much of input tax as is attributable for business. I'll give you a very simple example. The laptop which I'm using right now for uh, doing this particular Zoom meeting, this laptop is purchased by me and I have taken the complete ITC of this laptop. However, besides my professional work, I'm also using this laptop for my personal entertainment purposes or for my personal social media purposes. So to that extent, I am not using this laptop fully for business. Now, this particular point says that if in any tax period or if in any year it is found that the goods or services which you have brought are not fully used for business. They are partly used for business and partly for other purpose. Other means non-business. Non-business generally would be personal. Then you have to proportionate the ITC. You will not take full ITC. You will take proportionate ITC. Reason one for proportionate. Reason two. Reason two is I have purchased input services, capital goods, and I'm using it in my business only. So I'm not doing anything outside my business. So it is not subsection 1. Subsection 1 is over. I'm using these items completely in my business. Nothing is outside my business. But the point or the challenge is that my output, that is my sales, comprises of two things. One is there are some exempt supplies in my sales, and there are also taxable supplies. So let us say on my outward side, I'm selling two products, product X and product Y. Product X is taxable at 12% and product Y is nil, that is, it is exempt. Now, if my output is having exempt supplies, then again, section 17.2 says that the amount of credit which I am availing will be restricted, will be allowed only to the extent the input tax is attributable to taxable supplies. So where it is attributable to exempt supplies, my credit will not be allowed, or I have to proportionately reverse it. So basically subsection 1, subsection 2 gives you two different reasons for proportionately reversing the ITC. First reason in subsection 1, where you are using those goods partly for business, partly for non-business like personal. Second, where you're using it completely for business, but your output of the business is taxable as well as exempt. I hope this whole point is clear.
Yes, sir.
Student, perfect. Now, subsection 3 and 4, I'll explain, but let me take you to some detailings of this section. Along with this, we have some parallel rules that we'll be studying. Rule 38, most important 42, 43, which is the rule which will tell you how to do this proportionate. So we just saw that you have to make proportionate, but how to do this proportionate is given by rule 42 and 43. Now, analysis. So 17.1 and 2, these two subsections ask you to do proportionate, and how to do proportionate, that is given in rule 42 and 43. Subsection 1 says proportionate where you have utilized it for non-business purpose. Subsection 2 says proportionate where you are using it for taxable as well as exempt. Now, so 17.1 where you are using it partly for non-business, and 17.2 where you are using it for exempt. These are the two reasons where you have to proportionately reverse your ITC. Now they have come up with one special case scenario. Clarification on availability of ITC in respect of warranty replacement of goods or its parts and repair services during warranty period. Now, what is this point? The point is, see, I have sold you some goods. Let us say I am a dealer of television. My television is having 2 years warranty. That if any problem comes, I will replace the part, I will change the part, I will repair the television. And let us say you have bought a television, which is the latest smart TV costing rupees 2 lakhs. And I have given you 2 years warranty. Now, in these 2 years, what happens is, let us say the picture tube of your television is not working properly. So you come to the service center, you lodge a complaint, and as per my warranty, I have to replace this picture tube. Now, when I'm replacing this picture tube, I am providing you this picture tube free of cost. Now, the question comes, when I provide you free of cost, there is a problem in 17.5, that is the blocked list, which we are going to see further, that if I am providing anything free, I have to reverse the ITC on that free component. Now, the whole question or dispute is that when I am replacing any part under warranty, and obviously it has to be replaced free. That is, in other words, when I'm providing this picture tube to the customer free of cost, whether it will require me to reverse because I have provided it free of cost. The answer given in this circular is no, because even though under warranty I am providing or giving this picture tube free of cost to be used or changed in your TV, still the circular says, and this has come from the excise era, that this picture tube which I am providing is, even though appearing to be free, but as a businessman, I would have already included the value of this picture tube in the cost of my TV by applying the costing principles. And since it has been already included, hence, even though it appears to be free, actually it is not free. The cost of it has been included by me, and that is why I should not be required to reverse. This is the basic point given in this particular circular. So the main question that was raised is whether the manufacturer will be required to reverse. Why? Because he has not charged any consideration for this picture tube. This picture tube is given free to the customer or used free. So the answer is that it will not be required to be reversed. Why? Because firstly, it is not an exempt supply, even though I am giving it free, but I have already included its cost in my value of TV, and hence there is no exemption. It is not given free of cost. Its cost is already covered in my goods, and hence no ITC reversal is required. So they have given it in different case scenarios. What are the different case scenarios? I directly repair to the customer, or the customer goes to my dealer and dealer repairs it and get it back from me. In all these case scenarios, the answer remains same, that no ITC has to be reversed because there is nothing given free. There is nothing which is exempt. So in all these case scenario, the final output that comes is that I as a manufacturer am entitled to get ITC even of this picture tube which I have given free. Fine. Now we come to the main part, Rule 42 and Rule 43. Now what is this 42, 43 dealing with? We just saw section 17.1 and 2. 17.1 said, if I'm using my goods or services for non-business purpose, I should reverse the ITC proportionately. And where my output or my sales includes taxable and exempt, again I have to reverse the ITC which is applicable to the exempt supply. Now, how to reverse this? For this, elaborate formula is given in Rule 42, which is for input and input service, and in Rule 43, which is for capital goods. So why you have two rules? For input service, which is a recurring cost every month, how to reverse, that is given in Rule 42. And for capital goods, which is a one-time cost, how to reverse, that is given in Rule 43. Now, what does these rules say? We are firstly on Rule 42. So 42 says, first find out the total input tax of this particular month of all inputs and input services. So let us say we talk about December. Find out the total ITC of December. Obviously, that is what is coming to your 2A, and from 2A it is coming to 3B. Now, from this, remove the ITC which is on those items which are used exclusively for non-business purpose. So by chance, if in this ITC there is any invoice which is applicable to such goods or service which you have not used in business at all, that is, you are using it for personal use, remove it, because anyways you don't get ITC for that. Second, find out those input services which you are using exclusively for exempt supply. Now remember my example, I have two products in my output, X and Y. X is taxable at 12%, so it is a taxable supply. Y is at nil rate, so it is an exempt supply. Now, there would be some raw material, there would be some packing material which is used only for manufacturing Y. Since Y is exempt, I will not get any credit for Y. So whatever input services are used exclusively for Y, remove it. Why remove it? You don't get credit for that. Then comes the third part. Find out those input services for which credit is ineligible. Why it is ineligible? Because section 17.5, which we are going to study later, that blocks certain credits. Now remove all this. So from the total ITC that you are having of this month, which is called as T, remove these three ITCs, T1, T2, T3. Why? Because you don't get credit for them. One, which is for non-business. Two, which is exclusively for exam. Three, which is blocked. Now the balance that is left after reducing these ITCs is called as C1. It has no value, but they have taken a balance. Now they are saying, find out those input services which are used exclusively for taxable. This is what they have called as T4, and they are saying for the time being even reduce this. Now for the first three items, T1, T2, T3, when they are saying reduce this, I can understand because I am not eligible to take ITC for these three things. But here they are saying you reduce T4, which is actually my raw material, my packing material, which I'm using for the taxable product, that is X. I should not reduce it because actually it is eligible. However, they are saying reduce it for the time being because I want to find out what are your common input services. Common means which are used commonly for both X and Y. So this T4 you are reducing, but it is eligible to you. How it is eligible, you will come to know later on. But for the time being, subtract it so that now this is the most important balance. What is this important balance for? This important is for those ITC which are used commonly for X and Y. And I will have to do proportionate for this item only. I hope this is clear up to this point. Now, once I reach this point, now I have to do proportionate. Out of this C2, which we just found out, which is of common items, which is common for X and Y, I will find out proportionately out of this how much is for my exempt supply, which in my example is product Y. How will I find out this? Take this figure of common ITC, which is C2, multiplied by the sales value of Y, which is exempt, and divided by the full or total turnover, which is of X and Y both. So numerator, take the sale value of Y, which is exempt supply. Denominator, take total turnover, which is of X and Y both, and multiply this by C2. Now you can understand that this is a simple maths by which you are finding out of this common credit, which is C2, how much is the proportionate credit applicable to your exempt supply. This is called as D1. So D1 is the first amount, which is your proportionate ITC applicable to exempt supply.
Excuse me, sir.
Yes,
Sir,
beta.
here total turnover included services that are eligible for credit also.
But turnover means sales, na?
Sir,
So
sales.
sales is only of two products, X and Y. What you are saying is ineligible. Ineligible is the debit side, that is the credit item, na?
Yeah, okay.
Here sales is on the credit side, which is only two products. See, visualize a P&L. In a P&L on the credit side, sales is showing sales of X, sales of Y. That's it. That is only
Yeah,
your credit, na?
yes.
So this is the credit attributable to exempt supplies, right? Okay. So in step 1, we found out common credit, which is C2. And in step 2, we found out of this common credit, how much is attributable or how much is proportionate for the exempt supply. Now you find out D2. What is D2? As I said, some of my inputs are used even for non-business purposes, that is for maybe personal use. Now it is very difficult to find out how much of my input is used for personal use. So they have assumed it to be 5%. So they are saying, assume that 5% is your input which is applicable to non-business purposes. So this is the best part. Everybody will be happy doing this because that is a very small amount. So what we will do is take this C2 figure which you are having, multiplied by 5%. So you will get, as per the law, whatever is your common credit attributable to non-business. And now that will be called as D2. This D2 is the second item which is not eligible. Now, D1 was the proportionate ITC for exempt. D2 is the proportionate ITC for non-business. Now, the total of this is the ITC out of common, which is not eligible. Now find out what is the balance common ITC which is eligible. So C3 is the balance ITC out of common ITC which is eligible. And how do you find out C3? C2, what was the common ITC we calculated above? From that you subtract both these proportionate ITCs which are not eligible. D1 not eligible because of exempt, D2 not eligible because of non-business. So total common ITC C2, from that subtract D1, D2. Now this C3 is your final common ITC which is eligible. And in this C3, I don't know where they have written. In this C3, add T4. T4 was what? T4 was the ITC applicable exclusively for taxable supplies. Yes, Hemant, you are right. So in short, your final eligible ITC is 2. C3 plus T4. This is the final eligible ITC for this month. Did you get this? So this is how you find out the common ITC which is eligible, which is C3. In that you add T4. This becomes your total eligible ITC. I hope you all understood this. Students, great. Very good. This is one of the most technical calculations of the GST law. Okay. Now, if you understand this, let us also understand 43, which deals with how to find out common or proportionate ITC of capital goods. Now, capital goods, as you will understand and accept, is a one-time cost. It will not happen every month. It will happen only after some period of time when you again buy some capital goods. Now, in this particular case, whenever there is capital goods ITC, what you have to do is find out of, let us say you have 10 assets. Capital goods means you have 10 assets. You have different types of machinery, furniture, which are eligible. Now, find out those capital goods which are used exclusively for non-business purpose or exclusively for making outward supplies which are exempt. So let us say out of these machines, I'm using few machines which are exclusively working on my product Y, which is exempt. Now, since that particular Y is exempt, whatever machines I'm using for Y, the ITC of those machines are not eligible. Correct? So first step is, out of total machines, remove those machines which are used exclusively for making non-business or exempt supplies. Now, the second is, identify those capital goods which are used exclusively for making taxable supplies, even remove them. Why? Because these are fully eligible, but for the time being, remove them. Now, after removing those assets, machines which are used exclusively for taxable and exclusively for exempt, you are left with those machines or assets like your furniture or some common packing machine, which is used commonly for both X also and Y also. Now, These common machines ITC are the common ITC of capital goods. Now, this capital goods, we presume that the life is 5 years. 5 years converted into months is 60 months. So now we have found out those assets which are common assets used for both taxable as well as exempt items. These are your common assets. Whatever is the ITC that you have taken on these common assets divided by 60. Correct? What is this 5% and all? I'll explain later. So divided by 60, then you get the per month common credit, because all our workings are per month. So you have to find out the per month common credit. Now this per month common credit will be by taking the common ITC. Common ITC is ITC of those assets which are used commonly for X and Y. It will include all your furniture items because they are common, and includes those machinery like packing machinery which are common for both products. Now this ITC divided by 60 will give you your per month ITC. And if you have 4 such capital assets which are common, find out TM. TM is the per month ITC of capital goods. Find out TM of all those 4 machines or all those 4 assets which are common. Add the TM of all those 4 which are common. That becomes TR. Now somehow they have not shown the TR working, but what is TR? TR is total of TM. TM is what? Per month ITC of my common machines or common assets. I have 4 such common assets. So obviously each asset account is separate. So from every asset account, you find out the ITC. You divide it by 60. You get TM of first asset, of second asset, of third asset, of 4 asset. All are common assets. Add up the TM of all 4. That is what is TR. So TR is nothing but the per month total ITC of common assets. Now apply the same formula which we applied in 42. That is, numerator take the sales value of product Y, which is exempt. Denominator take the total sales value of X and Y and do proportionate. This will give you TE. TE is the portion of the common ITC which relates to exempt product. In other words, this is that amount which will not be eligible, because this much is proportionately applicable to the exempt product. Now, whatever is this amount of TE which is not eligible, that you will reverse in the current month's return. Now, why we are saying you will reverse this in the current month return? Because in capital goods case, maybe these machines are 1 year old, 2 year old. I would have already purchased it few years back. And whenever I purchased it, I have already taken the full ITC. So ITC, you take fully of capital goods. So now the ITC taking step is over. This is the reversal step which I do every month. So for every month, I find out the per month ITC by this formula. And then by this formula, I find out of that common per month ITC, how much is exempt or how much is proportionately applicable to exempt product. And this is the amount which I will reverse every month. I hope this is clear to all. Students, is this clear to all?
Sir, here we take it 5 years, right?
Correct.
Yes, sir. If we in middle we sell the asset, then we
Then
also
this
do
working
that.
will not come. Na? See, this asset is not there. Na? If this is sold, it means that asset is no more with you in your stock.
Sir,
Once it is
then
not in your stock, you
we
will not do this reversal.
yes, sir. We already taken ITC, so that was not affected, right?
No, beta, for that, you have a separate working which we are going to study later in section 18. So if asset is purchased and after 2-3 years you sell the asset, what is to be done of that asset's ITC, that you study in section 18. So
Okay,
that
sir.
will come. Don't worry. That will come. Correct?
Yes,
You
sir.
get my point? So it will come.
The meaning of this reversal, because you have already taken ITC,
Hmm.
what is the What is it?
Reversal is you are returning back.
Returning back means you are
See,
taking out
ITC you
something.
took, you added to
Hmm.
your credit ledger.
Right.
Now you remove it from the credit ledger. Correct, na?
Oh, okay. Suppose
Understood, na?
for example, suppose initially you have taken 100 as my ITC on
Correct.
those capital goods. Every month, suppose it comes to say 5. So from the 100 which we have already taken, and this 5, where will it reflect? That means what? It will be reduced from that 100.
Correct. Now see that 100, you may have already used it because every month you are selling the goods, you are having outward supply, correct?
Correct, yes.
Even if that 100 is used, no problem. You will show this 5 as reversal. If you have some
Oh.
ITC balance, it will reduce the ITC balance or you will pay out of your pocket.
Oh, okay, sir. Okay.
Correct, na? Understood?
Yeah. Yes, sir.
Great. Yes. What about others? Have you all understood this working? Excellent. So see, this is the most technical working according to me in entire GST. If you have understood this, nothing like this. So this is how common credit reversal is done. Right? Great. We stop over here. Next lecture, we continue from this point, that is how to proceed with some more special cases, like they have given something for insurance premium. For everything, there are now some special points, and then we'll go to block credits. But I request that at least up to this point, that is up to step 3, please read and come. Rather, step 4 is also done. So I've already said that this TE, which we calculated, will now be reversed. How it will be reversed? It will be added to your output tax liability. Simple. So the moment you add to your output tax liability, that much either you pay using the credit balance, if not, you pay out of your pocket. So it will be reversed, it will be paid. Now, next lecture, we study from this clarification. Understood, students?
Yes, sir. Yes, sir.
Yes, sir.
But please read this and come, because this is slightly technical. So I want you all to read it from the module, because definitely when you're reading from the module, you'll find some technical points, some words, which if not understood, we will discuss that first in the next lecture, and then we will move ahead. Right?
Okay, sir. Okay, sir.
Perfect then. So with this, we close our today's session. I'm sure even though we covered so many things, many conditions, some technical workings, still I hope everything is understood. But to consolidate it in your minds, please read it, do it again, twice or thrice maybe, so that you are ready with your doubt. Okay? Thank you all. Good night. Take care and please keep studying. Fine?
Thank you, sir. Good night.
Good night. Thank you. Bye-bye.